Hi everyone, my name is Rishad. Today is the 3rd of April 2023 and I'm going to be going over my weekly prediction for SPX. Now I had made the content for this video yesterday, but it has been posted today due to a medical emergency, so therefore I've posted it before the market opens. So as usual, I'll make a disclaimer before starting the video and we'll go over the monthly, weekly, daily charts along with the option chain to finalize the prediction for the week. So before starting the video, I would like to make all viewers fully aware that it is unadvised to take any trades based purely off of the information in this video, since all content in the video is purely for educational purposes and any trades are subject to market risk, so it is highly advised to consult a financial advisor before taking any positions since they're all subject to market risk. Okay, now that we've made the disclaimer, let's get into the video. So, from the monthly charts here, we can see really only one thing, which is quite obvious, and that is the upwards wedge price action, which I have marked over here. Now, upwards wedge price action tends to break downwards, meaning that the strong bullish price action that we've had for the past week or two can possibly be halted now. And since the month of March has ended, we can see that it has been a very bullish month, which is a hammer. Now, here is where it's kind of difficult because we have an upwards wedge pattern which breaks downwards 67% of the time, and we have a hammer which is a very, very strong bullish candlestick pattern. So, since the price action can continue in the upwards wedge, it is more likely that the prices go upwards for the month because a hammer is a very, very strong bullish candle, and it's more likely that the market goes upwards because of this candlestick pattern. And that's all we can see in the monthly charts. So let's move now to the weekly charts. As you can see, here's where things get a little bit more interesting, because inside of this upward wedge pattern, we have another short-term upward wedge pattern. So this means that the upwards wedge, the short-term upwards wedge, when broken, is also very likely to break the larger upwards wedge, meaning that whenever this event does happen, it could mean a super strong bearish reversal since it's breaking two price action patterns at once, so effectively breaking two supports at one time, which would mean this is a very, very strong bearish sentiment indicator. However, this is all that we can gain from the weekly charts, and since we know that the monthly charts did have a hammer, it is more likely that the bullish action is prolonged, at least for the next week or two, and then we'll see where the market takes us. Finally, let's go to the daily charts, and here is where we can really get our no trade zone, which I'll explain a bit later in the video. We can see in the last week we've had an excessively bullish market since it went down the first 2 days, then gapped the next 3 days. And another thing to note, if we go back to the weekly charts, is this pattern here, candlestick pattern. The three candles are forming a distinct three white soldiers pattern, which is yet again a very bullish pattern. So taking into conjunction everything from the monthly and weekly charts, we can we can expect the market to go up at least for the next week or two, since the hammer, a very strong candlestick pattern for bullish sentiment, and again, the three white soldiers to end off the month is a very, very strong bullish pattern and indicates a very, very large bullish sentiment in a reversal. As you can see, there has been a short downwards trend, and then this pattern has emerged, which is a form of a rally, and a very strong one at that. And most of the times when this pattern occurs, the bullish price action continues for a while. So let's go to the daily chart, and we can see here that the price has closed right above this resistance zone at 4101.44, and the price is currently at 4109.31. So from this we can kind of establish our no trade zone, because we can take the high of this candle, which is at 4148, and it was the high of a short swing. Actually, this was the high of the short swing, but I'm trying to alter my strategy a bit because that would be basically capitalizing on only up to 30% of a possible market movement in the week if it is completely bullish. So it's important to take into consideration previous candles highs, which for a safer option is this one, because it closed very close to its high, so we can see that the market did not really hit this one. However, here it went to the high and rebounded downwards, so it's slightly more volatile to take this one. Here, if we take this candle, we have a strong resistance point. And the support that we can take for the no trade zone is actually the low of this candle here, which is at 4089.49. So if we take these two candles in comparison, we have the support at 4089.49 and the resistance at 4148.11, which is not an extraordinarily large no trade zone, but more effectively what it does is places the last candle somewhere in the middle, which is really the intent of this no trade zone. Since there is no clear directional view, since the monthly and weekly price action shows an upwards wedge, which is largely a bearish price action pattern, whereas we have the three white soldiers and a hammer pattern, which means that there is an equality between the two signals, and therefore we need to be very safe where we go with this next week. Since this is the case, it is important to place this candle's close somewhere around the middle so that it can capitalize on whatever direction it can equally, and we can basically gauge which side is stronger, the bulls or the bears. And now that we have covered this, let's move over to the option chains. As you can see, for the monthly expiry, we have a high CE and PE of 4150 respectively, with a plus 250 change in the CE and PE. And since there is an equal change in the CE and PE, the signal can be negated altogether, with a premium of 4150 CE 44.80 and a premium for the 4150 PE at 79.64 and the put-to-call ratio of 2.04. Next, we have the weekly expiry, in which the highest CE and PE are both 4100 with a plus 200 change in the CE and plus 150 change in the PE, and both the CE and PE have changed. However, the CE has changed slightly more, so we can take it as a light bear signal, but in general, since both of them have gone up, it should be negated altogether since it is a very minor signal. The premium for 4100 CE is 34.70, and the premium for 4100 PE is 23.50, with the put-to-call ratio of 2.17. Finally, we have the daily expiry at for the highest CE at 4100 and the highest PE at 4100 as well, with a plus 150 change in the CE and PE. And if the CE is more, it is bearish, and if the PE is more, it is bullish, and we have the same two signals for 3 weeks. And since they change equally, it can be negated altogether. The premium for 4100 CE is 20.40, and the premium for 4100 PE is 10.41, with a put-to-call ratio of 2.48. And now that we've covered all of this information, we can clearly see that the option chain at large doesn't give us any clear signals. We have bullish and bearish signals in the candlestick pattern, but I do feel that because the main bearish candlestick price action pattern was in the monthly charts, and there's only a minor bearish pattern in the weekly charts and a bullish pattern in all three of the monthly, weekly, and daily charts, it is important to keep this trading range of which I specified earlier, but I do feel that there is a higher probability that the market breaks upwards. So my prediction for SPX this week is to wait for the trading range to break, but in my opinion, there is just a higher probability of the market continuing to go upwards based on the analysis this week. And that's all for this video, and I'll see you in the next one.